ICT concepts aren't actually hard, but they are massively misunderstood. And I have been there myself. I spent hundreds of hours watching ICT, studying non-stop, and yet I was stuck at the same place. But then everything changed, because I finally discovered the right way to trade ICT concepts. Something that is completely different from the usual approach that you see online. And just so you know, I'm not some random guy on the internet trying to preach ICT concepts. So make sure to watch the video all the way through, because this is the last thing that is holding you back. Alright, so straight into the video. How to trade ICT concepts as a low risk reward trader. Everything that I'm presenting in this video is basically ICT, but in a different way of manner. Because over the years I've built my own ICT concepts because I don't like the traditional way. Simply because most of the time it doesn't work. Now, do ICT concepts work to begin with? Matter of fact, I want you to go back into the chart and check it out for yourself. I don't want you to just take my word for it. Check it out for yourself, everything that I'm teaching in this video. As I have already mentioned, this is ICT, but it is modified to lower risk to reward trading. Because we as low risk to reward traders, we don't compensate on having a high risk to reward. We focus on something much more different. So it had to be modified. It is not the traditional way of ICT. And here you can see all of the different things that I'm about to teach you, right? We'll go over the different structures, liquidity, premium to discount, and so on and so on. And by the end, I will also show you how you can combine all of the following above with low risk to reward, so you'll be able to trade just like me. And if you have still questions by the end of this video, my Discord server is linked down below. You can ask me for free help, and I'm always happy to answer. Now, the first thing that we are going to look at is market structure. This specifically is consolidation. Now, what is consolidation? Consolidation is when the market not going to the upside, but it's also not going to the downside. That is consolidation. And I want you to focus on this little bit of price action right in here. We ignore everything else that is on the chart right now. As you can see, the market, yes, although it does go up and down, but it stays in a certain range, in this blue box. That is consolidation, when the market is not going up and also not down. As you can see, we are slowly moving to the bottom of the box, then to the top of the box, and that just keeps on going. Sometimes we're not going in any type of direction box-wise because we are also consolidation within the entire consolidation. But slowly we are reaching onto the bottom again, going a little bit higher, bottom again, and then eventually at the top again. Now, quickly to mention, no market phase lasts forever. There's always going to be a short period of uptrends and downtrends. Keep that in mind. It will not always be consolidating. Now, the next market structure are downtrends. Downtrends are very self-explanatory. It's trending to the downside. As you can see, we're slowly moving to the downside. We do have some pullbacks because no trend lasts forever. Even if you have a heavy downtrend, you will always find these little pullbacks, as you can see right in here. Because no chart goes straight into one direction forever and never returns. That doesn't happen. And as you can see, we have a nice little downtrend with some nice little pullbacks. Now, internally, we will also have a couple of little small backs, but the global trend is really just a downtrend. Now, and pullbacks are something that I also want to talk about. So as you can see, we are trending to the downside, but then we're going higher up again. This entire phase right in here is the entire pullback, right? But then also we have internally, as just mentioned, we're going to the downside right in here. But internally, we have small little pullbacks right in there. And then here again, small little pullbacks right in there. And you'll see that a bunch of times in the market, whether it's an uptrend or downtrend. That will be very important later on in the video. And of course, we also have uptrends. It is the same principle that I have just explained in a downtrend. Let's go over it quickly. So as you can see, we are trending to the upside. Then we are having our pullback phase right in here. And we're trending upwards again. We are having a little bit of a pullback phase right in there and trending upwards again. Now, as I have previously mentioned, no downtrend or uptrend lasts forever. The market will always go over these three structures that I have just explained to you. Always. However, there's also an exception. Sometimes the market doesn't really go in neither direction. It's not really trending. It's kind of not consolidating, but it's something right in between. It's kind of doing everything at the same time. So the exception is very simple to explain. Now sometimes you have a very big push to the upside, as you can see right in here. This little box is presenting the push to the upside that I was just talking about. But this is not indicating an entire uptrend, because previously, as we have seen, we are trending upwards, correction, and upwards again. But in this one, we are trending upwards just for a very short amount of time, consolidating, and then we're just going lower. These are the kinds of exceptions that you have to look out for. Because if not, then you will just trade this to the upside, although this is not an uptrend. But the same also goes for the downside. As you can see, this box is referring to the downside I'm talking about. But what happened before? You can't really differentiate, was this just a pullback of the uptrend, or what is it? So these are the exceptions that you have to look out for, and don't get trapped in those kind of situations. Now this gets very messy, so let me remove it real quick. We have also a little bit of a consolidation phase right in here, where after a strong push to the upside, we're just consolidating. This is also a very general thing of the market. If you have very strong movement to either side of the market tends to consolidate after that, because it has to take a break of all of this different pressure that it was building up right in here going to the upside. The same goes for the downside once again. After we have gone to the downside, you can see we're in the consolidation phase once again. And that is basically it for the market structure. You have to master all of these 3 different forms of market structure, or forms for that matter. And if you have done that, you already know where the price is going to go next and in what phase we are currently in the market. Now the next thing on our list is liquidity. What is liquidity to begin with? Liquidity is where a bunch of stop losses reside. Now what are stop losses? Stop losses is if you take a trade to the downside, for example, and your stop loss is right in here. Your entry, let's assume, is here, and your take profit is anywhere lower. Now your stop loss will get targeted by the market. That is a very common thing. That's why we have to identify high points of interest where liquidity resides. So we are not getting stopped out beforehand, but actually we are trading into the stop losses of other traders. So in the traditional way of trading, most traders see this as resistance, but that is wrong. These are relative equal highs. We have a swing high in there, another swing high in there, straight line from left to right. That is a swing high, and there is a bunch of stop loss residing above this level. So we are trying to trade it to the upside and not to the downside. So don't get fooled by resistance. Make sure to always know the right liquidity points. And here's a very common example of a trader who thought that this is going to be resistance. As you can see, the trader who took this trade thought that we'll go to the downside once we enter this kind of resistance level. But that is wrong. As I have just mentioned, we want to trade to the upside. So when you're taking a trade anything below that sort of quote-unquote resistance point, then you're right on the market. But if the resistance point has already been hit, then you're doing it wrong, because this trader got stopped out just like anybody who thought that this is going to be resistance. Now everything I say applies to both sides. You can see the trader thought that this is going to be support. This little area is supposed to hold, but that is again wrong. There's a bunch of other traders who think the same just like you, and that is why the market targets your stop losses. So instead of identifying the area where price is going to go next, before all of that kind of different stuff happened, and shorting anywhere in those points into the relative equal lows, the trader who got stopped out thought the opposite way, and that is exactly why it doesn't work. But as I have just told you, you're trading the liquidity completely the opposite way as you're supposed to do. So how can we do it the right way? As you can see, I've already marked down the swing low right in here. Now, this is a high point of interest. High points of interest always get hit by the market, as we have just talked about. But how do I know if this is a high point of interest or not? Because by theory, it could have been any of those, right? How do I actually know it? And you are going to find that out if you combine the things that I'm about to teach you. So we have just talked about liquidity. And to know where high points of liquidity are, we have to understand the premium versus discount zones. Now, the premium to discount zones are very self-explanatory. You take one swing high and you take another swing low. If you now split that entire range into 2 ranges and cut it into the middle, you have the premium and you have the discount range. But what is the premium and what is the discount really telling us? Now for the premium specifically, it is telling us that the asset that we are trying to trade right now is overvalued. So anything above this line means that the price is overvalued right now. And if something is overvalued, you want to sell it. You want to short it into the downside. And the same goes for the discount. Anything that is below the discount range, you want to buy it, so long it onto the upside. How can a premium to discount be used efficiently? The Premium to discount range is making sure that we are not taking a short, for this example, in a undervalued price. Because when you want to sell something, whether it's a bike, phone, or whatever it is, you want to sell it at the highest price possible. And premium to discount is ensuring that you'll always short at the highest price possible, basically. So by theory, you could have traded this anywhere above the center line and just traded to the downside onto this high point of interest. We will get into that in a second, what high points of interest really are. And as always, the same applies the opposite way. So if we think that this is an uptrend and we want to trade it to the upside, we wait until price taps into that center zone and goes below it. That is the point where we are going to take a long anywhere in here. And if you want to trade a very aggressive trade, you can even just set a limit order right in the center point of the premium to discount range, because we already know that this point is a high point of interest, so it will get hit. It's something that is heavily misunderstood and not used quite enough. So basically, if we draw our discounted premium from one high to the other low, we are sure that the center point will always get hit. Now, if you zoom in, there's a little bit of price action that went into the center zone, and that is my point of it. Price always returns back in the premium to discount ranges. Always. There has never been a time in history where price did not return back in the premium to discount. But only if it is used right and in the right market conditions. So you always want to make sure that you're using it either in an uptrend or in a downtrend. Because if it is consolidating and all of a sudden just keeps on uptrending, you will probably never see that premium to discount range getting hit. Only if you start adjusting your premium to discount range that eventually it will get traded back into again. So make sure to not get trapped in consolidation phases in drawing out your premium to discount. We have already talked about market structure. Make sure to identify those correct. So the next thing on our list is order blocks. Order blocks is the first liquidity point that I was referring earlier in the video. Now what have we just learned? If we draw Fibonacci from swing high to a swing low, and then draw the center line of both of these two areas, we have the premium to discount range. Now, in this current market condition, we want to take a sell because this is a downtrend, as you can see. So what are we doing? We're trying to find high points of interest where the market is more likely to go to then trade to the downside. And for that, we're going to use an order block. Now, what are order blocks? Order blocks are small hints of the market. So I want you to just focus on this little bit of price action. The market is going straight to the downside. As it is going to the downside, it's also leaving behind a couple of bullish candles. So those are bearish candles, and this is a bullish candle. Those bullish candles appear to be random while it's going to the downside, but actually they are order blocks. Order blocks are heavily targeted by the market, and most of the time we get back into them, especially if you combine it with a premium to discount range or the following concepts that I'm about to teach you. Now, a very common question is, do you draw the order block from the body or from the wick? And that is very simple, guys. Take the order block as an entire range. Take the wick low, but also take the wick high. Now, if we extend that single line all the way to the right, you can see that it got mitigated and we traded lower. But you have to make sure to combine it with a premium or discount range. As we have just talked about, this is a downtrend, so we are looking for a premium range. But if we were to go to the upside, we're looking for a discount range. Because this is where most traders fail. They just see an order block and straight up want to target it and go to the lows again. But that's wrong. You want to combine it with all of the different concepts that ICT has to offer as a whole. Now the next thing on our list are fair value gaps, or also known as FVGs. An FVG consists of 3 candles. We have candle number 1, we have candle number 2, and we have also candle number 3. Right between candle number 1 and 3, there's a gap forming right in here. That is basically a fair value gap. Now, how can we trade this? Now, I'm going to go back to the chart that we have just talked about to make things very clear and easy to understand. Now, how do you trade fair value gaps? As you can see, we have just talked about the order block right in there. But there's also a fair value gap right in here. As you can see, the fair value gap also got mitigated, traded into, and went lower. Now again, you have to combine it with the premium to discount. That's why I've included the premium to discount range first, before explaining to you the order blocks or the FVGs as a whole. Because again, if you just trade the order block by its own or the FVG by its own, then it's not going to work. You have to combine it, because everybody can spot a couple of order blocks or FVGs on the chart. So make sure to always pull out your Fibonacci tool to know where the center point is of your current price action. Now, of course, everything goes to the up and down sides. We have also another FVG right in here that is in a discounted range. Remember, the lower part is discount, the upper part is premium. Price traded into it, and you could have traded this easily to the upside because this is a high point of interest. The next thing on our list are kill zones or time of the day. When are you going to take a trade? And here's the thing. After years of trading, I've created my own ICT kill zones. That is the great part of low risk to reward trading. There is no specific time to trade at. You can trade at any given moment as long as you have a specific key area you're looking out for. Because I know it myself, when I was working a 9-to-5 job, I had to learn trading, but I also had to focus on my 9-to-5 job because trading was not going to pay my rent at that time. So that's why I've created this system where you can trade at any given moment. But there's a little bit more of the time of the day that we're going to trade. Basically, the reason why we are able to trade at any given moment is because we don't focus on the time of the charts, we only focus on the price of the charts. So, in simpler terms, we only want to know where the price is going to go next. Now for this example, we want to go for the lows because those are relative equal lows. And since our stop loss is extremely high compared to our take profit, we have no problem taking a short at any given moment. You could have taken a short at any given moment in time because you already know that this level will get violated. Because let's be honest, we as traders love to predict the charts. But let's be a little bit more realistic. We cannot predict all of it anytime and all the time. That's why we are only focusing on the price aspect and not time. Screw the time aspect completely in this way of trading. Now I'm sure you have a bunch of different questions. That's why my Discord server is free to join. You can ask me questions at any given time and I'm more than happy to answer them. Back to the video. Now finally we have arrived on draw on liquidity. How do you know that this low right in here is a high point of interest that the market loves to target? Basically, you're looking out for swing highs and lows on the chart. And I'm not just talking about any random swing highs and lows. They have to be the most extreme. So in this case, the most extreme is one here, one in here, one in here, and one in here. You don't want to go anything in between. Maybe this one, or maybe this one, maybe this one. No, only the very extreme highs and lows. Those are the swing highs and lows that we are looking at, and they will always be targeted by the market. And it also has to be on the daily time frame. So again, since we know that we are in a downtrend, we are waiting patiently for the market to trade back into the premium range. Because anybody who has shorted right in here has their stop losses above anywhere right in there, above this swing high. Those stop losses will get hit, which is more fuel for us to trade into the downside of things and take our profit. And here's the golden part of this video, combining with low risk to reward trading. ICT is a great way to determine where price is going to go next. But let's be honest, we have all been there. The direction was predicted right, but the timing was off. Here's another example. So the trader who tried to take this trade was right on the direction. Why? Because the price shot up into his initial take profit. As you can see, those are relative equal highs. And he wanted to trade back into them. But he made two mistakes. First of all, we have relative equal lows right in here. And those will get mitigated because this currently was an uptrend and this is just the pullback phase. But he got punished very hard for trying to predict the time aspect of trading perfectly because he wanted to take the perfect opportunity to get the most of his risk to reward as possible. And that happens to every single trader, including myself in the past. Now come on, how could this have been traded correctly? As you can see, we have relative equal lows in there. And we just had the relative equal highs that we are trying to trade back into. Instead of having, first of all, a massive take profit all the way to the upside, even though we overshot our take profit by a lot, we only target the relative equal highs. And additionally, our stop loss is exceptionally low because we don't really know when price is going to do that. Price might as well just went back a little bit lower and then shot up. So again, we're not trying to predict the time aspect of trading. Only the price. We only want to know where the price is going to go next. And in this case, we knew that it will go to the upside. Now, a very, very common question is, how do I know where my stop loss is going to be? And that is a topic for a way different video because this would explode the entire video right now. Now, although I have put ICT concepts in a very simple way, there is still way more to learn from me. If you want to trade like me and avoid the mistakes that I had to make in order to become this profitable, the Discord to my mentorship is in the description down below. And since you have made it this far into the video, you might as well like the video, Subscribe to the channel so you don't miss any future videos. Because you really don't want to miss out on this way of trading. This is the new wave of traders and we will break through the traditional way of trading. So see you guys in the next one.